Please like, share, and subscribe. Wishing you happiness and good luck every day.
So you've heard all the buzzwords, right? ESG, SRI, impact investing. It can feel like this huge, confusing world. Well, we're going to cut through all that noise. This is your essential guide to finally, and I mean finally, understanding what it all means. Okay, let's just dive right in. First things first, let's talk about the sheer scale of this thing. That number you're looking at, $35.3 trillion, that is the amount of money globally being managed under sustainable principles. Now, to put that in perspective, that's 36%, more than a third, of all professionally managed assets on the entire planet. So yeah, this is not some niche little trend. It's a massive shift in how the world's money is moving. But here is the big problem. Hiding inside that giant number is, frankly, a ton of confusion. When somebody says sustainable, are they talking about ESG? Or are they talking about socially responsible investing, SRI? Or maybe impact investing? It's this whole alphabet soup that makes it incredibly hard to know what you're actually getting. So our mission here, it's simple. We are going to make sense of that alphabet soup for you. So let's get right to it. We're going to untangle all these terms. And we'll do it by giving you a really simple but powerful framework to understand the key differences between all the major approaches. Okay, so the single most important thing to get your head around is this. Sustainable investing is not just one single thing. You have to think of it more like a spectrum of different strategies, and each one has a totally different primary goal. On one end, you've got approaches that are laser-focused on financial returns, and then all the way on the other end, you have strategies where the social or the environmental outcome is the absolute #1 priority. And to make that spectrum really easy to understand, we can basically break it down into 3 main flavors: socially responsible investing, or SRI, impact investing, and the really big one, ESG investing. Each one has a totally distinct purpose, and it answers a very different question for an investor. First up is the classic, socially responsible investing, or SRI. This is really the original values-first approach. The core idea here is super simple. Align your money with your personal ethics. And that usually starts with what you don't want to own. For years, this meant screening out what they called sin stocks, companies involved in things like tobacco or gambling or weapons. And what's really cool is how this example makes the whole idea of SRI totally concrete. So take the US Vegan Climate ETF. Its goal is to balance a financial return with a very specific ethical viewpoint. The method is really straightforward. It just actively excludes any company that's involved in animal exploitation, fossil fuels, and a couple of other industries. It's a direct reflection of an investor's personal beliefs put into action. Okay, so let's slide over to the next flavor, impact investing. And this is a really fundamental shift in thinking. The main goal here isn't just to avoid doing harm, it's to actively go out and create measurable good. Impact investors are looking to fund companies and projects that generate a specific, a positive, and a provable social or environmental outcome. And this example, wow, it just perfectly illustrates the point. Iroquois Valley isn't some stock you can trade on an app. It's a direct investment with a super clear mission: get more organic family farmers onto secure land. And just look at the details here. It's often for qualified investors, and it requires a long-term commitment. This is what you call patient capital, and it's aimed at solving a very specific problem. All right, this slide right here, this is the aha moment. Seriously, this is the key that unlocks this whole thing. See how it lays it all out on that spectrum we talked about? All the way over on the left, you've got conventional investing, totally focused on financial return. Then you see ESG, which uses sustainability data for that same financial goal. But as you move to the right, the motivation starts to change. SRI tries to balance both, and impact investing, it prioritizes that real-world outcome. This visual framework, honestly, it's the most important takeaway so far. So now that we have that spectrum locked in our minds, let's talk about the giant in the room, ESG. And as you just saw, it lives on the side of the spectrum that's focused squarely on financial performance. It might have been a newer term than SRI, but it has absolutely exploded to become the dominant force in this whole space. I mean, the numbers just don't lie. Of that $35 trillion we saw at the very beginning, a massive $25.2 trillion of it, that's over 70%, is managed using ESG integration. That means when you hear someone say sustainable fund out in the wild, the odds are incredibly high that what you're actually looking at is an ESG fund. So what exactly is ESG? Well, it stands for environmental, social, and governance. And here's the crucial difference. Unlike SRI, which is all about your personal values, ESG is a data-driven strategy. It's about using data on these non-financial factors, stuff like carbon emissions, labor practices, or board diversity, to get a smarter, more complete picture of a company's long-term risks and opportunities. So let's make this practical. This slide brilliantly shows the trade-off that pretty much every ESG investor faces. On the left, you've got a light tilt fund, which holds a ton of companies so it can perform just like the market index. Then on the right, you've got a strong tilt fund. It's way more concentrated, holding only the best-in-class ESG performers. So the question becomes, are you looking for returns that kind of hug the market, but with a light sustainability filter? Or are you willing to potentially deviate from the market to get a much stronger focus on only top-tier ESG companies? So you have to ask, who is driving all of this? Who's pushing this colossal shift towards sustainable investing, and especially ESG? Well, while individual investors like you and me are a huge part of it, the biggest waves are actually being made from the top down by some of the most powerful financial players on Earth. For starters, you have entire countries. Just take Norway's sovereign wealth fund. We're talking over $1 trillion of national wealth. They're using that financial muscle to divest from entire industries like thermal coal, and that sends a massive signal to the global market about where the future is headed. Then you've got the behemoths that manage our retirement money. These huge pension plans like CalPERS in California, which is responsible for the retirement of millions of public employees, are now mandating that their investment managers have to use ESG data. And let's be crystal clear, when a client that big speaks, Wall Street listens. And you absolutely cannot ignore the power of universities. Driven by these passionate, student-led movements, huge endowments at schools like Yale are being pushed to divest from fossil fuels and to completely rethink their entire investment philosophy. It's just a really powerful force for change. But listen, this is not just a top-down movement. The demand from everyday investors is absolutely soaring. And this chart really shows the generational shift in stark terms. Look at that. Interest among millennials is just skyrocketing. The message from the next wave of investors couldn't be clearer. This stuff matters to them a lot. Okay, that was a lot of ground to cover. So let's just pause for a second and lock in the single biggest takeaway from all of this. This is what it all boils down to. The most crucial point is this. Sustainable investing is not a monolith. It's a menu of options, If your main goal is to align your investments with your personal values, then you're looking for SRI. If you want your money to create direct, measurable, positive change in the world, well, that's impact investing. And if you're using non-financial data to find financially stronger companies for the long haul, that's ESG. It all comes back to one simple thing. Your goal determines the strategy. There's this fantastic little story in the source material for this explainer. One of the authors is at customs, and the agent asks him what he does for a living. He says sustainable investing. The agent just pauses, tilts his head, and asks, shouldn't all investing be sustainable? Meaning, shouldn't it all be built to last? It's such a simple but profound question that really gets to the heart of this entire shift. And that really is the perfect question to leave you with. Now that you have this framework, now that you can see the difference between investing for your values or for direct outcomes or for financial data, what's the first question you're going to ask about your own investments? What do you really, truly want your money to accomplish? It's something to think about. Okay, so let's get right into it. You've definitely heard the term sustainable investing thrown around, but what does it actually mean? If you're a little fuzzy on the details, trust me, you're not alone. It's a world that's just packed with jargon, but we're going to break it all down and make it super simple in this explainer. First off, let's just wrap our heads around the sheer size of this thing. We're talking about more than $35 trillion in sustainable investments globally. Now, to put that into perspective, that's more than a third of all the professionally managed money on the entire planet. This isn't some tiny little niche trend anymore. It is a massive, massive force in finance. And whenever you have that much money flowing into one area, the industry is going to respond. And they have. We're seeing what's been called a dizzying array of new products hitting the market. Just in 2020, over 70 new sustainable funds launched in the US alone. But here's the catch. While more choice sounds great, it's actually created a huge problem for investors. And that problem is just plain confusion. You see all these acronyms, ESG, SRI, impact investing, and they get used almost interchangeably. sometimes even by the very people trying to sell you these products. It makes it so hard to figure out what you're actually putting your money into. So, what is the difference? Well, that's exactly what we're here to clear up. And if you want to know just how confusing it can get, check out this story. There was an investor who mentioned that he ran a green investing firm. The person he was talking to, they immediately thought he was in the cannabis business. It's kind of funny, right? But it perfectly shows how tangled and muddled all this terminology has become. So, to cut through all that noise, we need a really simple way to think about this. And honestly, the best way to do it is to imagine it all on a spectrum. Okay, so this is our map. Think of it like this. On the far, far left, you have conventional investing. Its only goal is maximizing financial returns, period. Then on the far, far right, you have philanthropy, like donating to a charity, where the only goal is social impact. Everything we call sustainable investing fits somewhere in between those 2 points. All right, let's start our tour of this map with one of the originals, SRI, which stands for Socially Responsible Investing. At its heart, SRI is all about one word: balance. It's about trying to get a good financial return, absolutely, but doing it in a way that doesn't clash with your personal values. It's like you're filtering your investment choices through your own moral compass. So, how does that actually work? Well, traditionally, it was all about using what they call negative screens. That's basically just a do not invest list for industries you don't like, things like tobacco or weapons. But it's grown beyond that. Now, you can also use positive screens to actively seek out companies that are working on solutions you really believe in. The bottom line, though, is that the goal is to make your portfolio a reflection of what you personally stand for. Let's make this real with an example. Take the U.S. Vegan Climate ETF. Look at its primary goal: balancing financial return with social outcomes. It's right there in the middle of our spectrum, and you can see exactly how it does that by excluding companies involved in animal testing, fossil fuels, and tobacco. It's a perfect example of a fund built for an investor with a very specific set of values. Okay, so that's SRI. Now let's jump all the way to the other end of our spectrum and talk about impact investing. With impact investing, the priorities are totally flipped. The main goal, the number one reason for the investment, is to solve a specific social or environmental problem. Any financial profit you might make, that's just a bonus. The mission comes first. Yeah, think of this as mission-first investing. The goal here is to create a lasting solution, almost like how a charity works, but using a for-profit business model. Now, a few things make this really different. These are often investments in private companies, which means your money can be tied up for a long, long time. We're talking 5, maybe even 10 years. And because of that risk, these kinds of opportunities are usually only available to qualified high net worth investors. A fantastic real-world example is the Iroquois Valley Farmland REIT. Its entire mission is to boost organic farming by helping family farmers get access to land. The primary goal is that social outcome. The financial return is secondary. And look, you can see those restrictions we just talked about: a 5-year minimum investment, and it's only open to qualified investors. This is what mission-driven capital looks like in action. Okay, so we've covered value-driven SRI and mission-driven impact investing. Now we need to talk about the absolute giant in this space: ESG. ESG stands for environmental, social, and governance. And the key word, the one thing you have to remember about ESG, is data. This approach isn't really about avoiding bad companies based on your personal values. It's about using data on these non-financial things to get a smarter, more complete picture of a company's risk and its potential to perform well over the long haul. And when I say it's a giant, I am not exaggerating. Remember that $35 trillion market we started with? Well, ESG makes up a mind-blowing $25 trillion of it. This isn't just another flavor of sustainable investing. It is by far the most dominant approach in the world. So what kind of data are we talking about here? Well, it boils down to these 3 pillars. E is for environmental. That's things like a company's carbon footprint. S is for social. That's about its relationships, like how it treats its employees and customers. And G is for governance. That's all about how the company is run, from who's on the board to executive pay. The underlying idea is really simple. A company that manages these things well is probably just a better run, less risky investment. Now, this is where it gets really practical for most of us. Let's look at 2 popular ESG funds. Notice that they both have the exact same primary goal: maximize financial return. But they go about it differently. The one on the left, ESGU, holds more stocks and aims to perform very similarly to the main stock market index. The one on the right, SUSA, is more concentrated. It holds fewer companies that have really high ESG scores, which means its performance might stray a bit more from the index. So what this all means for you is that you get a clear choice. You can go for a lighter ESG approach, which will probably perform a lot like the overall market, but has a lighter sustainability focus. Or you can pick a stronger ESG approach, which gives you a much deeper sustainability focus, but might also lead to more ups and downs in your returns. It's really a choice between hugging the index or leaning more heavily into those ESG factors. Okay, wow, we have covered a lot of ground. We've broken down the 3 big categories. So let's bring it all back to that spectrum we started with and put all the pieces in their proper place. And here it is, our completed map. You can see it all laid out. ESG, over on the left, is a financial first strategy. It's using extra data to try and get better returns. SRI sits right in the middle, doing that balancing act between your financial goals and your personal values. And impact investing is way over on the right. It is mission first, putting social outcomes above everything else. So, now that you have the map, the big question isn't which of these is the best one. The real question is, which one is right for you? You now have the framework to make an informed choice. So, I'll leave you with this to think about. Looking at the spectrum, where do your own values and your own financial goals line up?
All right, let's dive into one of the biggest conversations in finance today, sustainable investing. We're going to open up the toolbox and break down exactly what it means and all the different ways you can actually do it.
You know, it's a question a lot of us are asking these days. I mean, we think about where our food comes from, who makes our clothes, so why not our investments? Is it possible for our money to not only grow, but to actually reflect our values and maybe, just maybe, help tackle some big world problems?
Well, the short answer is a big yes, but it's not quite as simple as just flipping a switch from regular to sustainable. The key thing to get is that there's no single way to do this. The best way to think about it is like a toolkit, you know? It's filled with different tools and you pick the right one for the job you want to do.
So here's our game plan. We'll start with what I call the gatekeepers. These are the methods that decide what's in and what's out. Then we'll meet the strategists, who dig a lot deeper. After that, we'll look at the activists, who use their investments to make change happen. And to wrap it all up, we'll look at the hard data to see how all these strategies stack up in the real world. Let's get started with the gatekeepers.
Okay, first up in our toolkit, the gatekeepers. These are really the most straightforward approaches. It's all about one simple idea: filtering. This is how you set the basic rules of the road for your portfolio.
The classic tool, the original, is negative screening. And honestly, it's exactly what it sounds like. You just make a list of things you don't want to support, say tobacco, weapons, maybe fossil fuels, and you just exclude them. You draw a line in the sand and say, nope, not in my portfolio. Simple, right? Well, maybe. A simple idea can get complicated really fast. Let's take an example. Say you decide you want to screen out companies involved with alcohol. So do you only get rid of the big companies that actually make the stuff? Or do you also have to exclude the giant supermarket chains that sell it on their shelves? And hey, what about all the bars and restaurants out there? The point is, even a simple screen forces you to think pretty carefully about where exactly you draw that line.
So, if negative screening is all about what you want to avoid, its polar opposite is, you guessed it, positive screening. The whole mindset flips from what you want to exclude to what you want to actively include. This is all about seeking out the leaders, the companies that are doing great things for sustainability. A really popular way to do this is called best in class. So instead of, say, avoiding all energy companies, you'd invest in the energy company with the best environmental record. You're basically rewarding the good guys and hoping the others take notice.
The last tool from the gatekeepers is norms-based screening. Now, with this one, you're not making up your own rules. Instead, you're using a rulebook that already exists. You're looking at established international standards from places like the UN, and you're screening out any company that doesn't meet that basic global bar for things like human rights and labor practices.
All right, moving on from the filters, our next set of tools belongs to the strategists. These methods go way beyond a simple in or out decision. This is where we get into much deeper, more integrated analysis.
The biggest tool here by far is ESG integration. This is where professional investors don't just look at spreadsheets and profit margins anymore. They systematically bake in environmental factors, like a company's carbon emissions, social factors, like how it treats its workers, and governance factors, like how its board is run. The whole idea is that these things aren't just nice-to-haves, they're absolutely fundamental to a company's performance in the long run.
Another strategist approach is sustainability-themed investing. This one's super focused. You're not just looking for good companies in general, you're putting your money directly into businesses that are part of the solution. Think funds that only invest in things like renewable energy, or clean water tech, or sustainable farming.
And that brings us to our final group of tools, the most hands-on of them all, the activist. This is where you stop being a passive owner and start actively using your money as a lever to create real change.
First up is impact investing. These are targeted investments where the main goal is to generate a specific, measurable, positive outcome. We're talking about things like financing affordable housing in a specific neighborhood or funding a company that's cleaning up the oceans. You can literally point to the good your money is doing.
The other activist tool is corporate engagement. This is based on a simple fact. If you own a stock, you own a piece of that company. You're a part owner, and owners get a say. This strategy is all about using that ownership to talk directly to management, to file proposals, and to vote at shareholder meetings to push companies to be better.
And don't for a second think this doesn't work. Just look at an initiative like Climate Action 100+. It's got 545 investors who together control $52 trillion in assets. When a group with that much financial muscle asks the world's biggest companies to get serious about climate change, you better believe those companies sit up and listen.
So, there you have it, the 7 main tools in the Sustainable Investing Toolkit. But which ones are investors actually grabbing for the most? Let's ground all this theory in reality and see what the data tells us. This chart gives us a fantastic snapshot of the market from 2016 to 2020. It shows us the total amount of money managed with each strategy, and, just as important, how fast each one is growing. Let's pull out the 2 big headlines from this.
First, when it comes to just sheer size, ESG integration is the undisputed heavyweight champion of the world. By 2020, more than $25 trillion were being managed this way. That tells you that mixing sustainability into financial analysis isn't some niche idea anymore. It's gone completely mainstream.
But size isn't the whole story, right? The award for the fastest grower goes to sustainability-themed investing. It grew by an incredible 605% in just 4 years. That's an explosion, and it signals a huge, growing hunger from investors who want to put their money to work on specific solutions.
So what's the big takeaway from all this? I think the most important thing to remember is that you don't have to pick just one tool. In fact, they're way more powerful when you combine them. You could use a negative screen to get rid of the really bad actors, then use ESG integration to find the leaders, and then use your power as a shareholder to push those leaders to do even better.
And really, that brings us to the final question, the one that's just for you. Now that you've seen what's in the toolbox, what's going to be in your investing toolkit?
You know, sustainable investing isn't some fringe idea anymore. It's a massive global economic force. But who's really pulling the levers behind the scenes? Well, today, we're going to follow the money and uncover the powerful investors who are literally reshaping our world.
Okay, to really get a sense of the scale here, you have to start with this number, $35.3 trillion. That's how much was invested sustainably across the globe at the start of 2020. I mean, that is more than the entire economies of the United States and China combined. It's a truly mind-boggling amount of money.
So the big question is, who is actually moving all this cash? It's not just one group, not by a long shot. It's this really diverse coalition of players, from the absolute largest institutions on the planet all the way down to individuals like you and me just making choices in our own retirement accounts.
We're going to start at the very top, the biggest of the big, the giants. We're talking about entire countries and the massive pension funds that are responsible for the futures of millions of people.
First up, you've got sovereign wealth funds, or SWFs for short. The easiest way to think about these is like a country's national savings account. They manage a government's extra cash, which often comes from selling natural resources like oil, and their job is to invest it for the long-term benefit of all their citizens.
So, let's take Norway's fund. It's the largest in the world, and here's the kicker. It was built entirely on oil money. This fund is so enormous, it owns about 1% of every single publicly traded company on Earth. And yet, this oil-funded giant is now selling off its investments in oil and gas exploration. I mean, talk about a powerful signal for where the future of energy is headed.
And it's not just Norway. Other huge oil-producing nations like Abu Dhabi and Saudi Arabia are doing something similar with this one planet framework. They're all realizing that, hey, even for us, climate change is a fundamental financial risk. The key takeaway here? They're now building climate risk directly into how they manage their national wealth. It's become a core part of the strategy. Okay, now let's talk about the other giants in the room, pension plans. And look, if you thought sovereign wealth funds were big, pension funds are on a whole other level. We're talking about the retirement funds for millions of teachers, firefighters, and government workers. There are dozens of these funds managing over $100 billion each.
This quote from the world's largest pension fund, Japan's GPIF, just says it all. They're not investing for next quarter, they're investing for the next 50 years. So for them, making sure the planet and society are healthy in the long run isn't some political statement. It's their core duty, their fiduciary duty to protect the retirement savings they've been entrusted with. It's just smart, long-term investing.
But here's the thing. This whole movement didn't start with trillion-dollar funds. No way. It started with a much smaller and, you could say, more passionate group of trailblazers. These were folks driven by their beliefs and organizing on college campuses.
Yeah, the roots of sustainable investing go back decades. Back in 1971, a church group used its shares to pressure General Motors over apartheid in South Africa. Just a year later, Yale University literally wrote the book on ethical investing for big institutions. And by the 1980s, student-led movements made divestment a really powerful tool for driving social change.
These faith-based groups were the true pioneers. At first, they just did simple avoidance or screening, refusing to invest in industries they were against. But they evolved. They started organizations like the ICCR to actually engage with companies and push for change from the inside. Then, fast forward to 2015, and you have Pope Francis powerfully connecting those traditional faith-based concerns directly to modern issues like climate change.
Now, university endowments, they were inspired by all this, but they face a really tricky situation. They have to balance the demands of current students and faculty, who are often pushing hard for change, with the expectations of their alumni, who provide the money and might have very different ideas. It's this internal tension that makes their journey into sustainable investing super complex.
Okay, let's shift gears now and talk about the modern financial ecosystem. The wealthy families and the big Wall Street firms that took these early ideas and just scaled them up dramatically. So first you have what are called family offices. These are basically private investment firms for the world's wealthiest families. And because they're only accountable to the family, they have incredible flexibility. They can go way beyond just avoiding bad companies and actively pursue what's called impact investing. Basically, putting their money into projects designed to create a specific positive outcome. And the scale here is just immense. I mean, through things like the Giving Pledge, wealthy individuals have committed over $1 trillion to philanthropic causes. You've got foundations like the Gates Foundation and Bloomberg Philanthropies deploying tens of billions of dollars to tackle everything from global health to climate change. They are directly shaping the world with their financial power.
Of course, you can't talk about Wall Street without talking about BlackRock, the largest asset manager in the world. Their CEO, Larry Fink, writes these hugely influential annual letters, telling companies that climate risk is investment risk. But activists are always quick to point to their voting record. Between 2015 and 2019, records show they supported only a tiny fraction of environmental and social shareholder proposals. So there's this really interesting disconnect people point to between their public message and their past actions.
So, we've looked at the giants and the big influencers. But what about the rest of us? Well, the final piece of this puzzle is the growing power of individual investors.
And the demand from individuals is just undeniable. A 2019 Morgan Stanley survey found that 85% of the general population is interested in sustainable investing. And get this, for millennials, that number jumps to 95%. This isn't just a passing trend, it's a fundamental shift in how an entire generation wants to invest their money.
So the market has responded to this incredible demand. A few years ago, it was actually kind of hard to find a sustainable fund. Today, there are over 400 in the US alone. But this has created a totally new problem. The challenge isn't a lack of choice anymore. It's trying to navigate this really confusing landscape of products, all claiming to be ESG or sustainable.
So what happens when you combine the power of the giants, the passion of the trailblazers, the influence of Wall Street, and the demand of everyday people? Well, you get a movement that has officially gone mainstream.
And a huge factor in this shift is the rise of these investor coalitions. Take the Principles of Responsible Investing, or PRI. Its members manage over $100 trillion in assets. These coalitions bring together all these major investors so they can speak with one unified and very loud voice.
And the whole purpose of these coalitions is pretty simple: amplification. Think about it. A single pension fund asking a big company to change its ways is one thing. But what about 500 investors who together manage $52 trillion, all asking for the exact same thing? That is a voice that is pretty much impossible for a corporate board to ignore. So from those early faith-based pioneers all the way to today's trillion-dollar pension funds, this incredibly diverse group has pushed sustainable investing from the margins right into the absolute center of global finance. They've already completely changed the conversation. The only real question now is, what are they going to demand next?
All right, let's talk about sustainable investing. You hear about it all the time, but what's really going on in the mind of an investor who chooses it? Are they just trying to make money and save the planet at the same time? Or is there something deeper, something more personal happening? We're going to dig into all of it.
And look, this isn't some niche topic anymore. The interest is just massive. A 2019 survey from Morgan Stanley found that 90%, yeah, 90, of millennials want to invest this way. That's not just a trend, that's a whole generation thinking differently about what their money is for.
And that brings us right to the heart of the matter. When someone picks a sustainable fund over a standard one, what's the goal? You've got to figure it's about more than just the financial bottom line.
To really get our heads around this, we have to realize that investing, just like almost any big decision we make, isn't just a numbers game. It's packed with all sorts of different benefits and motivations.
You know, the finance expert Mayer Statman has this perfect analogy. Think about giving someone a rose versus just handing them $10. Now, the $10 has what you'd call utilitarian value. It's practical. But the rose, well, the rose has expressive and emotional benefits. It says something about how you feel, and it makes the other person feel something special.
Let's break that down just a little more. A utilitarian benefit is about what something does. You know, like a car's gas mileage. It's the practical stuff. But the expressive and emotional benefits, that's about what it says about you and how it makes you feel. And here's the kicker. Investing works the exact same way. And this is where we get to the core idea for this entire explainer. Sustainable investors aren't just looking for one kind of return on their money. They're actually seeking three very different types.
So we can take that whole rose analogy and map it directly onto investing. It's pretty cool. The financial return, that's your utilitarian benefit. It's the money you make. The societal return is expressive. It's the statement your investment makes about the kind of world you want to live in. And finally, that personal return, that's purely emotional. It's that good feeling you get when your money is lined up with your values.
Okay, first up, let's talk about the money, the financial return. This is absolutely crucial to understand. Not all sustainable investing is the same. The kind of financial outcome you can expect really depends on the strategy you pick.
So let's look at the three main flavors here. First, there's impact investing. This is usually in private markets, and the number one goal is a specific social outcome. Because of that, the financial return can be all over the place, from losing everything to a 10 times gain. Then you have socially responsible investing, or SRI. This tries to balance values and returns, maybe by cutting out whole industries like tobacco. That approach can sometimes cause it to underperform the market. And finally, you've got ESG. That's environmental, social, and governance. This one is much more financially focused, looking at sustainable factors that might actually help a company's bottom line. The returns here often look a lot like the broader market.
Okay, so on to our second return, the societal return. This gets at that big, maybe even a little cynical question: does choosing one of these funds actually change anything in the real world? You hear this critique all the time, right? If you decide not to buy a stock, somebody else will, so what's the point? You're not really cutting off a company's money. And listen, for one single person doing one single trade, that's kind of true, but it completely misses the big picture. The real power isn't in one transaction, it's in the huge collective signal that the demand sent. When millions of us choose sustainable funds, it pushes the entire industry to build more and better products. It literally changes the conversation from just how much money can we make next quarter to how can we create long-term value. And maybe most importantly, it gives activist investors the muscle they need to go inside companies and push for real, tangible change.
And that signal is getting unbelievably loud. Right now, it's estimated that a full third of all professionally managed money in the US now uses sustainability criteria. That's a massive chorus of investors all saying, we want something different.
And that demand backs up some serious action. Just look at this ladder of how investors engage. It can start out pretty friendly, writing a letter or having a meeting, but it can ramp up all the way to filing formal shareholder resolutions, running campaigns to vote board members out, and even lawsuits. This is how the market forces companies to pay attention.
All right, let's move to our third and final return, the personal return. This one is all about the emotional side of things, that feeling you get when your investments just feel right.
So, what's driving that feeling? It really boils down to a few common things. It's that sense of integrity you get when your bank account and your beliefs are on the same page. It's the feeling of empowerment, like you're voting with your money every single day. And ultimately, it's about wanting to be part of the solution and to leave this world just a little bit better than you found it.
There's a quick story from the source material that just nails this idea perfectly. Let's talk about Sam. For 2 decades, 20 years, he was a happy customer at Wells Fargo.
But then, the fake account scandal hit the news. And all of a sudden, every time Sam used an ATM, he felt kind of gross. He felt complicit, like his money was helping this company do these awful things. He felt like he was part of the problem.
So he did something about it. He moved all his money to a local credit union. And now, he knows his capital is helping people in his own community get loans. That yucky feeling was gone, replaced by a little sense of pride. He now feels like part of the solution. That feeling right there is the personal return. So, after walking through these 3 very distinct returns, it's time to pull it all together and really turn the question over to you. At the end of the day, this is what sustainable investing really is. It's the search for all 3 returns at the same time. It's this idea that our money can do more than just grow. It can also be an expression of our values and give us a real sense of purpose.
And that really leaves us with one final thing to think about. When you look at your own investments, what are you really looking for? Is it just about the numbers? Or are you also looking for a return on your ideals? A return on your vision for the world? And maybe just a return on your own peace of mind?
All right, welcome back. Today we are digging into a term you have probably heard everywhere lately, ESG. That's environmental, social, and governance investing. It is easily one of the hottest and, yes, sometimes most controversial topics in finance. So, let's unpack how this thing went from a pretty niche idea to a multi-trillion-dollar force.
Let's just start with a number that's kind of hard to wrap your head around. $16.6 trillion. That's how much money, according to the U.S. SIF Foundation, was being managed using ESG strategies in the U.S. alone by the start of 2020. I mean, to put that into perspective, that's over 97% of all the money out there that's considered sustainably invested. It's huge.
So you got to ask, right? How on earth did ESG get this big, this fast? I mean, we're talking about just 15 years or so. Well, to really get it, we actually have to rewind the clock to what came before ESG was even a thing.
The ESG story really starts with its much older predecessor, socially responsible investing, or SRI. And this was not a new idea at all. People have been thinking about how their money and their values line up for literally hundreds of years. And here's the key difference between the two. SRI was all about values. It was about using screens to make sure you didn't invest in things your ethics disagreed with, like tobacco or weapons. But ESG? Well, ESG evolved to be about something else entirely, analyzing financial risk and opportunity. And SRI, for all its long history, had this one massive roadblock that just kept it from going mainstream. And that roadblock was data. Simple as that. Early on, sustainable investors were basically flying blind. They just didn't have consistent, comparable data to really evaluate companies in a systematic way. And without that, you can't build solid portfolios. You're just sort of picking and choosing based on the little information you can find.
So, this big data problem, well, it led us straight into the first real phase of ESG's evolution. And the big idea was to fix it with something everybody already understood: ratings. What happened was you had these early ESG research firms like MSCI and Sustainalytics, and they basically just copied the playbook from financial analysts.
They'd send out these massive surveys to companies, collect all this data on environmental, social, and governance stuff, and then they'd boil it all down to one single simple score, like an A+ or a 75 out of 100.
But this created a huge problem. One study called it aggregate confusion, which is a great name for it. You'd get this weird situation where the same exact company would get a great score from one rating agency and a totally mediocre one from another. So what gives? Well, they were all using different metrics, measuring them in different ways, and giving them different weights. It just created a ton of noise.
And this is where it gets dangerous, because a single, simple score can hide a fatal flaw. The Volkswagen emissions scandal is the perfect, if painful, example. VW actually had a decent overall ESG score, but that average number completely masked the ticking time bomb of its terrible corporate governance, the very thing that let the cheating happen. It proved that one little score just wasn't enough to spot a risk that could literally destroy a company.
Okay, so the whole ratings thing clearly had some big issues, and that forced a change, a big one. The market needed something smarter, which brought us to ESG 2.0 and this really powerful concept called materiality.
So what is materiality? Honestly, it's just about cutting through the noise. Instead of trying to track every single sustainability issue under the sun, it asks one simple, powerful question. Which of these issues could actually hurt or help this specific company's bottom line? It completely shifted the focus from broad ethics to cold, hard financial pragmatism.
I mean, just think about it. For any company, there's this whole universe of potential issues they could be judged on. You've got everything from greenhouse gas emissions and how they manage water, all the way to their labor practices and, how they handle data security. It's just a massive amount of information to try and sort through.
And this is where materiality is so brilliant. You had organizations like the Sustainability Accounting Standards Board, or SASB, come along and do the heavy lifting. They created these materiality maps that basically identified which of those dozens of issues were actually financially relevant for each specific industry. It was the filter everyone needed.
And here is a perfect example of how it works. Think about a mining company. For them, workplace health and safety is a huge material risk. Why? Because a bad accident can shut down operations and cost an absolute fortune. Now, what about an investment bank? For them, data security is everything. A data breach could destroy client trust and lead to massive, massive fines. It's all about context.
So this whole focus on materiality, it brings us right up to today to ESG 3.0, which is really all about one thing: creating reliable, standardized, and auditable data that everyone can actually trust. And to really get this shift, think about it like this. The push for ESG standards today is a lot like the push to create standardized financial accounting, what we know as GAAP, back in the 1970s. Before that, companies could report their profits almost any way they wanted. Standardization brought trust and comparability to financial markets, and that's exactly the goal for ESG data right now.
And the data itself is going through a total revolution. I mean, it used to be that we were just relying on what companies told us in their annual reports and surveys. But now, oh man, we're talking about a whole new world. We're talking about satellite imagery that can literally spot methane leaks from space, or analyzing public employee reviews on Glassdoor, or even using real-time supply chain monitoring.
Now, at this point, you might be thinking, okay, this is interesting, but this feels like it's just for a certain type of investor. But here's the thing. This is why this whole evolution matters to everyone in the market today. The game has totally changed.
If the 2010s taught the financial world anything, it was this, and it was brutal. Climate risk is investment risk, period. This is no longer some niche, values-based concern, it's a core financial reality. And you don't have to take my word for it. The proof is right there in the price tags. Hurricane Sandy, the insane wildfires in California and Australia, the Texas power grid failure, the heat dome. These weren't just news headlines. They were incredibly expensive events that hammered investment portfolios and forced even the most traditional investors to pay very, very close attention. And then came the real turning point. In 2019, Moody's, one of the biggest credit rating agencies in the world, bought a climate risk data firm. But they didn't just sell this data to ESG investors. No, they started integrating it into all of their standard investor reports. That was the signal. What was once alternative data was now essential. And if there was any doubt left, you get Larry Fink, the CEO of BlackRock. We're talking the largest asset manager on the planet, coming out and saying,
we will make climate change central to our investment strategies. When that happens, you know it's not just a trend anymore. It's the new reality.
Which really leaves us with one last fascinating question to think about. As ESG keeps evolving from this values-based idea into a really sophisticated, data-driven tool for analyzing risk, is the line between sustainable investing and just plain smart investing starting to disappear altogether? It's something to think about. Thanks for tuning in.
Welcome to The Explainer. Today, we're really digging into the performance of sustainable investing, and we're basing this on some extensive research put together by Larry Swedroe. We're going to peel back all the marketing hype and just look at what the hard financial data actually tells us.
This is, the big promise of ESG and sustainable investing, right? This idea that you can do well by doing good. And look, it's an incredibly appealing concept. I mean, who wouldn't want that? But the real question is, does it actually hold up to scrutiny?
Well, what's fascinating is that the underlying economic theory tells a very different, and honestly, a much more interesting story. It suggests that doing good with your investments might actually come at a cost. So, let's dive into the evidence and separate what sounds good from what the financial mechanics really show.
Okay, so first we've got to wrap our heads around a core economic theory that completely flips the script. I mean, it turns everything you'd probably expect about the performance of good versus bad companies on its head.
So, think of it this way. You know how some people are happy to pay a little extra for an organic apple? They're getting a non-financial benefit, right? They feel good about their choice. Well, in the world of investing, this is called taste-based investing. When a whole bunch of investors prefer good companies, they're basically expressing a taste. And that taste has a direct impact on the price of a stock. And here's the key part. Therefore, it impacts your expected return.
And what's really interesting here is how this just boils down to basic supply and demand, but for stocks. So when a stock is super popular, say everyone wants to own the hot green company, all that demand pushes its price way up. The thing is, a higher price today means a lower expected return for you tomorrow. And, as you can probably guess, the exact opposite is true for those shunned or so-called sin stocks.
So, the theory goes that investors in these so-called sin stocks, tobacco, gambling, that kind of thing, they're actually rewarded with higher expected returns. And why? Well, this extra return is basically seen as compensation for the social or emotional cost of owning companies that a lot of other people find, frankly, offensive and actively avoid.
Okay, so that's the theory, and it suggests a pretty clear divide, right? But, and this is a big but, for any of this to actually work in the real world, we have to be able to reliably tell which companies are good and which ones are not. And, well, that's exactly where we run into a major problem.
I mean, you'd think this would be pretty straightforward, wouldn't you? But the reality is something researchers call aggregate confusion. The very agencies that are supposed to be the referees here, the ESG raters, they often don't agree. In fact, they disagree a lot.
And this chart just brilliantly illustrates the chaos. I mean, look at it. It's plotting ESG rankings from two huge agencies, MSCI and Sustainalytics. Now, if they agreed with each other, you'd see a nice, clean diagonal line. But instead, it's a total shotgun blast. A company that's ranked highly by one is often ranked terribly by the other. It's all over the place.
And to make this even more concrete, just look at this example. For its environmental impact, one rating agency puts Facebook in the bottom 1st percentile. Another one, it places them in the top 96th percentile. I mean, how on earth can an investor make an informed decision when the so-called experts are on completely different planets?
So, researchers dug into why this is happening, and they found it pretty much boils down to 5 key things. The agencies, they're all using different metrics. They're comparing companies to different benchmarks. They handle missing data in their own ways, and they all put different weights on the E, the S, and the G. So this isn't just a little bit of noise. It's a fundamental systemic lack of consensus.
Okay, so if the ratings themselves are kind of a mess, what happens if we just sidestep them completely and look at the actual performance of really clearly defined categories? Let's just compare the most obviously sinful stocks against the most virtuous ones and see what the numbers say.
The historical data here is genuinely startling. Okay, so from 1900 all the way to 2019, $1 invested in the broad U.S. market would have grown at about 9.6% a year. Not bad, but that same dollar, if you'd invested it in the tobacco sector, arguably the most shunned industry of all, it would have grown at 14.2% per year.
And trust me, over a century, that difference isn't just big, it's absolutely astronomical.
And look, this isn't just some ancient history. A much more recent study looked at a vice fund, so alcohol, tobacco, and gaming stocks, from 1996 to 2016. It returned 11.5% a year, absolutely crushing the S&P 500's 7.8%. And get this, it did it with less market risk. You can see here the beta is lower, which is just a fancy way of saying it was less volatile than the overall market. So not only did you get higher returns, it was actually a smoother ride to get there.
But here's where the story gets really complicated. When we zoom in on a hot-button issue like carbon emissions, the evidence starts pointing in completely opposite directions. One huge study found there was a carbon premium, meaning investors were actually paid more to own high-emission stocks. But then, another recent study found the exact opposite. It said green firms have significantly outperformed as investor tastes have shifted so dramatically toward them. So, what gives?
So what are we supposed to do with all this? I mean, how do we make sense of it? We've got this really strong economic theory on one side, and then on the other, we have this very powerful but totally conflicting performance data. It's a real puzzle.
Okay, let's try and tie this all together. Here are the key takeaways. You've got decades of financial theory and historical data all suggesting that good, popular stocks should deliver lower returns in the long run. But then you have the reality of right now. A massive recent flood of money into green assets has jacked up their prices, delivering fantastic short-term performance. So the million-dollar question is this the new normal, or is it just a temporary repricing event, kind of like a one-time sugar high, that's eventually going to lead to those lower returns that the theory predicts?
So, when you choose to invest sustainably, what are you really doing? Are you consciously paying a premium to align your portfolio with your principles, accepting what the theory says should be a lower future return? Or are you making a bet that today's reality, this massive green wave, is going to defy economic gravity and just keep delivering those outsized returns? You know, the evidence really shows there's no easy answer here. There's just a very clear choice you have to make between long-term financial theory and today's incredibly powerful trend.
So, sustainable investing, ESG. You hear these buzzwords everywhere, right? But what do they actually do? Well, today we're going to cut through all that noise and find out what the real measurable impact is when you put your money where your values are. All right, let's get right to the heart of it. This is the big question, isn't it? Does sustainable investing actually change the world? Or is it all just, a feel-good sticker you put on your portfolio? That's what we're going to unpack. For the longest time, trying to get a straight answer to that question was, it was a total mess. The data was a complete puzzle. You'd read one study that said one thing, and then another that said the complete opposite. It was enough to make your head spin.
And this slide just lays it all out perfectly. On one side, you've got the optimists. They've got piles of studies showing that high ESG scores go hand in hand with great financial performance. But then, on the other side, you've got the skeptics, with their own stack of research finding either a negative link or no link at all. So what's the deal? Well, a lot of this confusion comes down to that classic trap, thinking just because two things happen together, one must be causing the other. Okay, so that confusion is what led to a major breakthrough. To really get it, we have to look at how ESG actually works. A really important study back in 2019 by Giassi and his team decided to just ignore the simple correlations and instead hunt for the specific mechanisms, what they started calling transmission channels. So, what on earth is a transmission channel? The easiest way to think about it is like financial plumbing, or maybe a line of dominoes. It's the specific, traceable path that shows you how a company's good or bad ESG behavior ends up affecting its stock price and its profits. The point is, it's not some kind of magic. It's a real, traceable mechanism. And if you understand these, the whole puzzle starts to make sense.
Okay, first up is the cash flow channel. And the logic here is, it's actually pretty simple and elegant. It turns out companies that are good at ESG are often just plain better-run companies. They're more efficient, they're more innovative, and they treat their people better. All of that makes them more competitive, which means more profits, and here's the part investors love, higher dividends. It's really just about operational excellence.
All right, now for the second one, the risk channel. And this is where things get really interesting. A high ESG score is a fantastic signal for good risk management. It means a company is way less likely to get hit with a massive scandal, a billion-dollar lawsuit, or a disastrous accident. In the world of finance, they have a fancy term for this, lower tail risk. But really all that means is they're just way better at avoiding those huge, company-killing disasters.
And that leads us right into the third piece of the puzzle, the valuation channel. It's simple supply and demand, really. When a company has a great ESG reputation, more investors want a piece of the action. That demand drives down the company's risk and makes it cheaper for them to borrow money or issue stock. That's its cost of capital. And when your cost of capital goes down, your company's overall value, its valuation, goes up. It's a huge financial tailwind.
And look, this isn't just some nice-sounding theory. The researchers actually proved it with data. They found, and this is a quote, that upgrades in ESG ratings were associated with declines in a firm's systematic risk profile and increases in valuation. That's it. That's the cause and effect link everyone was looking for. It's like watching those dominoes fall, one after another, exactly like the theory predicts.
Okay, so we've seen how all this investor pressure hits a company's finances. But what does it actually feel like on the inside? How does it change what the company does day to day? Well, it creates this incredible ripple effect that changes company behavior from the inside out, starting with its own employees.
Check this out. A study in 2021 found something fascinating. Just having a high ESG rating by itself didn't really move the needle on stock performance. And just having happy employees, that gave a small boost, about 2.4%. But when you put the two together, high ESG and happy employees, boom, you get this massive outperformance. We're talking a 5.8% alpha. That's not just a little bump, that's huge.
And here's the real takeaway. ESG isn't just a checklist of policies that you can write up in a boardroom. As the study concluded, employee satisfaction is an important condition for ESG to actually create value. It's all about building a culture where people actually want to come to work, where they feel like they're part of something bigger. That's the engine that turns good intentions into real results.
All right, so we've covered the S for social and the G for governance. It's time to tackle the big one, the E for environmental. Can your investment choices actually help the planet? Is there any hard evidence that this whole movement is making a dent in pollution?
And the answer seems to be a pretty clear yes. Just look at this number. From 2014 to 2018, right when sustainable investing really took off, the average carbon intensity of public companies in the US fell by 30%. 30! Now, sure, other things were going on, but that is a massive drop that's pretty hard to just write off as a coincidence.
And this chart helps explain why that might be happening. Investors are literally putting their money where their mouth is. The data shows that funds that got a special low-carbon eco label attracted over 3% more cash every month than regular funds. It's pretty clear. Money talks. And right now, it's screaming at companies to go green.
But of course, it's never that simple, is it? We've got to talk about a pretty serious complication called carbon leakage. What some studies found is that when one country tightens its environmental rules, some big global companies just shift their polluting activities to other countries where the rules are weaker. So the pressure works, but sometimes all it does is move the problem somewhere else. The pollution gets exported, not actually eliminated. Okay, so all of this brings us to our final big idea, walking the talk. The truth is, this isn't a simple black and white world. It's full of nuance. And if you want to be a smart, effective investor in this space, you've got to be able to see past the headlines and understand the details. Which, of course, leads to the big, uncomfortable question. Are these so-called sustainable funds always what they claim to be? And the short answer is, nope, not even close. Researchers have found that a surprising number of funds are, as they put it, only pretending. There's a name for this, of course, greenwashing, and it's something you absolutely have to be on the lookout for. So you might think, okay, I'll just sell all the bad stocks, right? Divest. But it's not quite a silver bullet. As this research points out, when you sell a stock, you're just transferring ownership to someone else. The company doesn't just vanish. But, and this is the critical part, it does hurt them indirectly by making it more expensive for them to do business. Remember that whole valuation channel we talked about? This is it in action. You're still applying pressure.
So, there you have it. Sustainable investing, it turns out, is a lot more than just a nice label. It has real power that works through clear, traceable financial channels. It creates actual ripple effects inside companies and across the entire planet. But it's not a magic wand either. It's complicated. There's greenwashing and carbon leakage to watch out for. The thing is, now you know how the machine actually works. The real question is, what are you going to do about it?
All right, today we're going to tackle a really big question. How can you get your investments to actually line up with your values without throwing all the rules of smart financial planning out the window? We're going to give you a super clear, practical guide to building a sustainable portfolio. And you know what? You might be surprised at just how straightforward it can be.
So, does this question hit home? If it does, you are definitely not alone. So many of us want our money to do some good in the world, but the whole idea of sustainable investing can just feel overwhelming, right? With all the jargon and the different options, it's so easy to feel lost before you even get started.
But here's the good news, and this is really the key takeaway for today. Building a sustainable portfolio, well, it uses the exact same foundation as the traditional investing you're already familiar with. You don't have to go learn a whole new language. You're just adding a new, really powerful layer on top of what you already know.
So let's start with that foundation. Adding a sustainable lens to your portfolio doesn't magically change the fundamental rules of smart investing. These principles, they're your bedrock. They don't change.
These 4 pillars are absolutely non-negotiable. First, markets are efficient, so don't even try to outsmart them. Second, diversification is still your best friend for managing risk. Third, you got to think long-term. We're talking decades, not days. And finally, always keep your costs low. These rules are just as crucial in sustainable investing as they are anywhere else.
Okay, so with those principles firmly in mind, how do we actually build this portfolio? Well, it all comes down to a clear 5-step game plan that should look very, very familiar.
See? This process probably rings a bell. First, you figure out your financial goals and how much risk you're comfortable with. Next, you decide on your asset allocation. How much to put in stocks, bonds, all that stuff. Then comes the fun part, picking your actual investments. After that, it's just regular maintenance, monitoring, rebalancing, and finally, you give the whole plan a checkup every year. It's a disciplined, totally standard approach.
And what's so interesting here is that most of this is just standard practice. The one step, the only step that's really different and where you're going to focus your energy is step 3, selecting your investments. This is where you get to bring your values right into the heart of the process.
And this slide just illustrates that point perfectly. Just look at these 2 pie charts. On the left, you've got a conventional portfolio. On the right, a sustainable one. See how the asset allocation, the actual slices of the pie, can be identical? You're not reinventing the wheel. You're just swapping a standard equity fund for an ESG equity fund, a regular bond fund for an ESG bond fund, and so on. Your core strategy doesn't have to change at all.
Okay, so let's zoom in on that critical step 3, selecting your investments. This is where you make the choices that really align your portfolio with your values. And the very first decision you have to make is what kind of investment vehicle you're going to use.
You've basically got 2 main paths here. You can use something like a mutual fund or an ETF, where your money is pooled together with a bunch of other investors. The cool thing about that is it gives you a much stronger collective voice to influence companies. Or you could use what's called a separately managed account, or an SMA. Now that gives you way more customization to perfectly match your specific values, but your own individual influence is a lot smaller. For most people, a fund or an ETF is going to be the way to go.
Okay, so you've decided to go with a fund. Now what? How in the world do you pick a good one from the hundreds and hundreds that are out there? Well, this is the core of our explainer today. I'm going to give you a simple but really powerful 4-part framework to test any ESG investment manager.
This right here, this is your toolkit. Think of it like a litmus test. Whenever you're looking at a fund, you're going to evaluate it based on these 4 criteria: ESG quality, ESG tilt, shareholder engagement, and manager commitment. And by the way, ESG just stands for environmental, social, and governance, the 3 big pillars of sustainability. So let's break each one down.
First up is ESG quality. The key question here is the manager doing real, honest-to-goodness work, or are they just greenwashing? A quality manager will have a really clear strategy and use independent data, not just those standard ESG ratings you see everywhere, which can be kind of misleading. For example, they might have their own team digging into a company's supply chain to check out its labor practices, instead of just taking a rating at face value.
Next up is ESG tilt. This is all about how strongly the fund leans into sustainability. Some funds have a pretty light touch, and they'll closely track the overall market. Others have a really deep tilt, meaning they heavily prioritize only the most sustainable companies. Now, more tilt means a bigger potential impact, but it also might mean its performance varies a bit more from the broader market in the short term. It's a choice, and it's one you get to make.
Third, we have shareholder engagement, and this one is so important. A great manager actively uses their influence as a shareholder to push for real change. This could mean voting for more diversity on a company's board or talking directly with leadership to get them to set ambitious carbon reduction targets. The point is, they're not passive owners. They are active agents of change.
And finally, there's manager commitment. Ask yourself, are they just selling a product, or are they truly committed to this cause? You can see it in the industry groups they join, the advocacy they do for better standards, and this is a big one, how they run their own business. Are they actually walking the talk on things like diversity and climate risk inside their own firm?
So as you can see, while the overall investment process looks pretty much the same, the real effort, and frankly, the real opportunity in sustainable investing comes down to this one crucial stage. Choosing your managers thoughtfully, using this four-part framework, is exactly how you make sure your portfolio is truly doing the work you want it to do.
And that brings us to the final question, which is really a question for you. You now have the toolkit to go from feeling confused to feeling clear. You've got the framework to cut through all the noise and find investment partners who are genuinely committed. So the only question left is, what kind of impact are you ready to make?
Hey everyone, so today we're going to dive into a topic that's getting a ton of buzz, sustainable investing. And look, it's way more than just a trend. It's really about aligning your money with your values. We're going to break down how it all works, what the real trade-offs are, and the actual impact it can have. Does this feel familiar? Yeah, if you're feeling a little lost trying to figure this out, you are definitely not alone. The world of sustainable investing can honestly feel like a maze. So our goal today is simple. We're going to cut through all that noise and give you a clear map. Okay, let's just jump right into the biggest headache for most people, which is how confusing this all is. The investment industry has seen the huge demand for sustainable options, and they've responded with, well, a flood of new products, but not a whole lot of clarity to go with them. ESG, SRI, impact, values-based, you've heard them all, right? The industry kind of throws these terms around interchangeably. This lack of a common language makes it incredibly hard for you, the investor, to even know what they're looking at, let alone try to compare different funds. And the problem goes way deeper than just the names. The agencies that rate these companies all use their own secret sauce. They use different metrics, they weigh things differently, which means a single company can get completely different ESG scores. So one group might give a company an A+, while another gives it a C. It's a total apples to oranges nightmare. All right, let's get to the question that's probably on everyone's mind. Does investing with my conscience mean I have to sacrifice returns? This is where we get to the heart of the real economic trade-off. Basic economic theory actually gives us a really clear way to think about this. So as more and more investors pile into so-called green companies, all that demand pushes their stock prices up. Now, that's great for the company. It means they can raise money more cheaply. But for you, the investor buying in, that higher price means your potential for future profit, your expected return, is actually lower. And the exact opposite happens with so-called sin stocks. They're less popular, so their prices are lower, meaning they have to offer higher expected returns to attract any investors at all. So what's the actual price of sticking to your principles? Well, a major study in 2021 tried to put a number on it. And what they found was that, on average, investors have been willing to accept about 1% lower expected returns just to align their investments with their values. You can think of it as the cost of putting your money where your mouth is. But wait a second. You're probably thinking, hold on, all I ever see are headlines about how ESG funds are crushing it. If they're supposed to have lower expected returns, how do you explain the amazing realized returns we've seen lately? Let's unpack the difference between the hype and the reality. And this is the central puzzle we need to solve. Between 2018 and 2020, the data shows that a typical green portfolio didn't just beat the market. It absolutely demolished it by a whopping 7 percentage points every single year. So how is that even possible if the theory says returns should be lower? I mean, just look at that. A 14% annual return versus the market's 7%? That's double. At first glance, this data seems to completely blow our economic theory out of the water. But there's a really important detail hiding in plain sight. The answer wasn't that these companies magically became twice as good overnight. Nope. It was a classic case of supply and demand. A tidal wave of cash, we're talking billions of dollars, poured into sustainable funds. All that buying pressure temporarily drove up the prices of the stocks those funds hold. And this quote from the research just nails it. This period saw high realized returns. That's the money that investors actually pocketed. But, and this is the crucial part, this was a short-term boost driven by that cash flow. It doesn't change the long-term expected return, which is still tied to the company's fundamental value. Okay, so we've talked a lot about your portfolio and your returns, but let's zoom out now, because where you decide to put your money doesn't just affect you. It sends these powerful ripples out across the entire economy. Think about it this way. Every dollar you invest is like casting a vote. It's a signal you're sending to the market, to CEOs, to boards of directors, telling them what kind of business practices you value. And when millions of investors all start sending that same signal, companies have no choice but to listen. And this is where you can see the real-world impact. As we talked about, the green companies get cheaper access to money, which helps them invest and grow. At the same time, the brown companies find it more expensive to operate. On top of that, the research shows that companies that take ESG seriously just tend to be more profitable and better managed. Your investment choices literally help create these incentives. All right, so we've covered the confusion, the performance puzzle, and the real-world impact. Now let's bring it all home and put it together into a practical playbook you can actually use to invest smarter. So before you put a dime into any sustainable fund, you've got to do your homework. Here's a simple 4-step checklist. First, really dig into its screening methods. What do they actually include or exclude? Second, check its factor loadings. That's just a fancy term for seeing if the fund is tilted towards certain types of stocks, like tech or small caps. Third, look at industry concentration. You don't want a fund that's accidentally put all its eggs in one basket. And finally, an old classic, scrutinize the fees. Make sure you're not overpaying. This is your essential checklist. So what is the big number one takeaway from all of this? Well, sustainable investing can be a great way to reduce risk in your portfolio. But once the market matures and that huge flood of new money starts to slow down, we should expect that trade-off we talked about earlier to hold true. A slightly lower expected return becomes the price you pay for investing according to your principles. But that new settled equilibrium point, it might be a long, long way off. I mean, check out this staggering projection from Deutsche Bank. They estimate that by 2035, 95% of all invested assets will be considered sustainable. And that leads us to a final, really fascinating question to leave you with. If, in the near future, nearly all investing is sustainable, what does that word even mean anymore? What happens when sustainability is no longer a niche, but just the default for everyone? What will it mean to do good with your money then? It's definitely something to think about as this entire landscape keeps changing. Today, we're tackling something huge in the world of finance, socially responsible investing, or SRI for short. Now, you hear about it all the time, right? It feels super modern. But what if I told you that's not the whole story? Not by a long shot. So just how big are we talking? Well, get this. Right now, a full 1/3 of all assets managed professionally in the US fall under this umbrella. 1/3. I mean, that is just a staggering amount of money. And yet, with all the buzz around ESG and impact investing, you'd be forgiven for thinking this is some brand new thing, something cooked up in Silicon Valley or on Wall Street. But is that really where it all started? Nope, not even close. To really get a grip on the trillions, yes, trillions of dollars we're talking about today, we've got to rewind the clock. Way, way back. All right, so let's start our journey. And we're not starting in a modern boardroom. Nope. We're going back to ancient religious texts. Because, believe it or not, that's where the very first ethical rules for finance were written down, thousands of years ago. I mean, just look at how far back these ideas go. The core concepts that shape how we invest today, they didn't just pop up in the last century. They have these incredibly deep religious roots that go back for millennia. So take ancient Judaism, for example. There's this concept called tzedek, which basically means justice or equity. And this wasn't just some abstract spiritual idea. It was a very practical rule for life. It said that if you owned property, you had a real responsibility to make sure it didn't cause any harm. And that principle eventually got applied directly to shareholders. Think about it. If you own a share, you're a part owner of that company, right? So according to this logic, you also inherit a piece of the responsibility for what that company does. This led people to actively avoid investing in businesses they considered immoral. Okay, now let's look at another ancient framework, In Islamic finance, which was laid out in the Quran over 1400 years ago, we see this key principle called riba, and its whole purpose was to prevent people from being exploited financially. So the philosophy here is that money is just a tool, a way to exchange things. The idea that money can just grow on its own through interest is seen as exploitative. And that leads to some very clear rules. No earning interest and no investing in industries that are seen as harmful, things like alcohol, weapons, and so on. So, what we have here are two really powerful ancient models. On one hand, you've got the Jewish concept of tzedek, which is all about the responsibility of being an owner. On the other, you have the Islamic principle of riba, which focuses on prohibiting exploitation and certain industries. And these two ideas, together, really laid the ethical foundation for everything we're going to talk about next. Okay, so how did these ancient ideas turn into actual action? Let's jump forward to the early modern era and see how faith-based activism started to take shape. So let's fast forward a bit to the 1700s. This is when we start to see religious groups, like the Quakers, take these principles and turn them into organized activism. They were really pioneers in this. And then came a huge moment. In 1758, the Quakers in Philadelphia officially banned their members from taking part in the slave trade. I mean, think about that. This wasn't just a friendly suggestion. It was a direct financial order, connecting their faith to their wallets in a way that was pretty radical for the time. And it wasn't just the Quakers. Around the same time, you had Methodist leader John Wesley preaching a very similar sermon. He argued that people should avoid investing in what we'd now call sin stocks, tobacco, firearms, alcohol, basically any business that could harm people or the community. And this is so important because it's basically the invention of modern exclusionary screening. This idea of actively avoiding or screening out certain industries based on your values is a fundamental strategy in socially responsible investing today. It's exactly how many modern investment funds work. Okay, so we've got the ancient blueprints and the early activism, but things really kicked into high gear in the 20th century. This is when these ideas just exploded into the mainstream thanks to some massive social and political shifts. I mean, look at this timeline. Every decade added a new layer. In the 60s, the Vietnam War had students demanding their universities sell off stocks in defense companies. Then the 70s gave us the first Earth Day, which brought environmentalism into the investing conversation. The 80s had these terrible disasters like Chernobyl and the Exxon Valdez oil spill that put a huge spotlight on corporate responsibility. And then, in the 90s, things got professional. The Damani 400 Index was launched, which was the very first tool to actually measure how well these socially responsible portfolios were performing. And all of that momentum brings us right up to today, where this long, rich history has been streamlined into a really powerful new framework that you've probably heard of. And that framework is ESG. Environmental, social, and governance. It's basically a way of taking all these historical ideas and packaging them into a simple, clear structure. It gives investors a lens to look at a company's impact that goes way beyond just the numbers on a spreadsheet. And ESG didn't stay on the fringes. Big global players, especially the United Nations, helped make it mainstream. They launched things like the Principles for Responsible Investment, the PRI, and the Sustainable Development Goals, or SDGs. These initiatives gave Wall Street and other big investors the tools and the language they needed to really integrate these ideas into their day-to-day business. So, when you boil it all down, what's old is new again. This whole movement, whether you call it SRI or ESG, it isn't some new trend. It's really just a modern expression of a very ancient idea about justice and responsibility. So we've gone from principles of justice written down thousands of years ago to a global financial force that directs trillions of dollars. The idea of investing with our values is more powerful than ever. Which, of course, leaves us with a huge question for the future. Now that 1/3 of all this capital is finally listening, what are we going to ask it to do next?
Okay, let's talk about something huge. A decision that can literally shape your entire financial future. We're going to dive right into one of the most important questions you'll ever face as an investor.
So, you're at a crossroads, right? Do you take the wheel yourself, become a DIY investor, or do you hand the keys to a professional? These are two totally different paths, and there's no single right answer. It really all depends on you.
Choosing to manage your own money isn't like trying to fix a leaky faucet at home. If you mess up the plumbing, hey, you can always call a pro to fix your mistake. But making a big financial error, that can take years to bounce back from, and sometimes the damage is permanent. The stakes are just incredibly high. So, to help you figure this out, we're going to run through what I call the do-it-yourself gauntlet. It's 5 tough, honest questions you need to ask yourself to see if you're really truly ready to be your own financial quarterback.
All right, question 1 is all about knowledge. And I'm not just talking about picking a few hot stocks. We're talking about a deep understanding of how everything, investments, taxes, insurance, your will, how it all fits together like a giant interconnected puzzle.
Next up, the math. And look, this goes way beyond simple addition and subtraction. To be a successful investor, you need a solid grasp of things like probability and statistics, so you can actually understand risk, how different assets move together, and the true range of what could happen to your money.
And then there's the strategy. Can you actually design the right mix of stocks and bonds for your specific life goals? This stuff often involves pretty complex tools, like Monte Carlo simulators. And frankly, using those tools the wrong way can be even more dangerous than not using them at all.
Okay, how about history? Are you a student of financial history? Do you know how many times the market has tanked, how long those downturns lasted, and how bad they got? Because, as they say, if you don't know the history, you're pretty likely to repeat its most expensive mistakes.
And now for the last one, which might be the most important question of all. Do you have the emotional discipline to see your plan through when everything is going crazy? Just think back to the 2008 financial crisis, or that sharp drop in early 2020. Were you cool as a cucumber, or did you feel that panic rising in your chest? Be really honest with yourself here, because this is the exact point where most DIY plans just completely unravel.
You know, that whole emotional piece we just talked about, that discipline question, it leads us straight into this really critical concept in finance known as the behavior gap. It's pretty much the main reason why so many people end up doing worse than the actual investments they own.
So what is this behavior gap? Well, it's what happens when our very human emotions, fear and greed, get in the driver's seat. It's that urge to buy high when everyone's excited and sell low when everyone's panicking. It's the gap between a logical plan and what we actually do when we're scared. And it can be devastating.
And this isn't just theory. The cost is real and it is huge. Take a look at this. Year after year, study after study shows that the return the average investor gets is way lower than the return of the funds they're invested in. That gap you see right there, that's the price of making decisions with your gut instead of your head. So, after going through that gauntlet, what's the verdict? Well, the honest truth is, only a tiny, tiny fraction of people have the right combination of knowledge, time, skills, and the emotional steel to manage it all on their own. And you know what? That is perfectly okay.
So if you're in the majority, and most of us are, and you decide you need a pro, how in the world do you find a good one? Well, your search should be built on 4 solid, absolutely non-negotiable pillars of trust.
These are the 4 big ones. They must be a fiduciary. They must invest their own money the same way they invest yours. That's called eating their own cooking. Their advice has to be based on real academic evidence, not hunches. And they need to offer a complete integrated financial plan. Let's break them down.
Okay, this first one is a deal breaker. You have to understand this. A fiduciary has a legal duty to act in your absolute best interest, period. The other standard, suitability, is much weaker. It just means they can sell you something that's suitable, even if there's a better, cheaper option for you, but a worse one for their commission. You should always, always demand a fiduciary.
Now, for this idea of evidence-based advice, let me paint you a picture. Imagine you go to your doctor for a serious diagnosis, and to figure out what's wrong, they reach over and grab a popular health magazine. Or, instead, they pull out a peer-reviewed, scientific publication like the New England Journal of Medicine. Which one do you want them to use? It's a no-brainer, right? Well, your financial health deserves that same level of rigor. Your advice should come from decades of academic research, not from whatever's hot on Wall Street this week.
Look, a really great advisor does so much more than just pick stocks for you. To be honest, that's just one piece of the puzzle. Their real value comes from weaving every single part of your financial life into one single coherent strategy.
I mean, a top-notch firm is like your personal CFO. They're helping you think about college funding for your kids, complicated estate and tax stuff, how to be smart about charitable giving. They'll even weigh in on big decisions like mortgages and insurance and help you prepare the next generation for the wealth they might inherit. It's the whole shebang.
Now, obviously, this kind of comprehensive advice isn't free.
But it's so important not to just ask, what does this cost? The better question is, what is this really worth to me? I mean, what's the value of getting your time back? And what's the price tag on genuine financial peace of mind?
There's this quote that just nails it perfectly. While good advice doesn't have to be expensive, bad advice almost always will cost you dearly, no matter how little you pay for it. Focusing only on finding the cheapest person out there can easily become the most expensive mistake you ever make.
So in the end, this decision isn't just about spreadsheets and returns. It's about being able to focus on what matters most: your family, your career, your passions, knowing that someone you trust has your back financially. So I'll just leave you with this one question to think about. What is that peace of mind worth to you?
Hello and welcome. Today we are going to demystify the world of sustainable investing. Now, it's a space that's growing incredibly fast, which is awesome, but it also means there are a ton of choices. So our goal here is simple: to give you a framework to find the funds that are genuinely right for you.
Does this look familiar? You decide, hey, I want my money to make a positive impact. So you search for ESG funds, that's environmental, social, and governance, and bam, you are suddenly staring at hundreds and hundreds of options. It is so easy to feel completely paralyzed by choice. But don't worry, there's a really simple way to cut through all that noise.
And here it is, the big secret. The best sustainable portfolio isn't some one-size-fits-all thing. It's actually deeply personal. The key isn't to find the single best fund out there, but to find the best fund for your goals, your comfort with risk, and probably most importantly, your values.
This idea is really at the heart of our source material. The entire process should be built around you. So instead of starting with a massive list of funds, we're going to start by helping you figure out what kind of sustainable investor you actually are.
So what we're going to do is use a simple framework that groups investors into a few key profiles. Think of them as investor personalities. By figuring out which one sounds the most like you, you can seriously narrow down your options and focus on what really, truly matters.
So here's our game plan. First, we'll explore some core approaches for those of you who like to be more hands-on. Then, we'll move on to some super simple all-in-one solutions. And we'll wrap up by looking at how you can align your investments directly with the causes you're most passionate about.
All right, let's dive into our first category. This is for the investor who kind of enjoys the process of building their own portfolio, picking and choosing different funds for different things like U.S. stocks, international stocks, and bonds.
First up, we have the index investor. If your motto is something like low cost, diversified, and keep it simple, then this is probably you. You're not trying to be a hero and beat the market, you just want to capture its returns as efficiently as possible, all while applying a sustainable filter, which basically means screening out companies with poor track records on the environment or social issues.
And yep, here are just a few examples. Whether you want exposure to the U.S. market, international stocks, or even bonds, there are low-cost, passive ESG options out there for just about every major part of your portfolio.
Okay, now for a slightly more nuanced approach, we have the dimensionally affiliated investor. You also want market-like returns, but with a little twist. The strategy here involves tilting the portfolio slightly toward factors that historically have been shown to deliver higher returns, things like smaller companies, value stocks, and really profitable firms.
So what's the big difference here? Well, think of it this way. While the index investor wants to perfectly mirror the market, the dimensional affiliate investor is trying to get a little bit of an edge. They'll add a slight, research-backed tilt towards certain types of companies, hoping it pays off with a small performance boost over the long run.
Our third core profile is the engagement-oriented investor. For you, investing isn't just a passive activity. It's about using your power as an owner. You want your fund manager to be actively talking to companies, pushing them, and using their shareholder votes to improve how they operate.
And there are some fantastic funds out there that specialize in exactly this. Managers like Walden, Green Century, and Calvert are famous for their shareholder advocacy. They're not just picking and choosing companies, they are actively working to make them better.
Okay, but what if building a portfolio from scratch sounds like a lot of work? Hey, that's totally fair. If you prefer a set-it-and-forget-it kind of approach, this next category is gonna be for you. These are the all-in-one solutions designed for maximum simplicity.
So the first type is the balanced fund investor. Instead of buying a separate stock fund, a separate bond fund, you just buy one single fund that does all that work for you. It holds a preset mix of everything, and the fund manager takes care of all the rebalancing. It's that simple.
But balance doesn't mean it's the same for everybody. These funds are specifically designed to match your personal risk tolerance. So whether that means a more conservative fund with fewer stocks or a growth-focused one with a lot more, there's an option for you.
And for the ultimate in hands-off investing, we have the target date investor. I mean, this is simplicity on a whole other level. You just pick a fund with a year that's closest to your goal. Let's say retirement in 2050. The fund starts out aggressive and then automatically and gradually gets more conservative as you get closer to that target date. You don't have to do a thing.
And hey, this isn't some niche fringe idea anymore. Natixis, for example, pioneered the first full lineup of ESG target date funds, offering options for long-term goals that range all the way from 2020 to 2060.
All right, finally, let's look at our most personalized category. This is for the investor who wants to go beyond broad ESG screens and really focus their capital on specific themes or causes they feel deeply passionate about.
For instance, are you passionate about promoting gender diversity and seeing more women in corporate leadership roles? Well, there are specific funds, like the ones you see here, designed to invest in companies that are really leading the charge on this exact issue.
Or maybe your number one issue is climate change. This is hands down one of the most popular themes, and you have great options here too. You can choose funds that completely avoid fossil fuel companies or ones that specifically seek out and invest in climate leaders.
And really, the possibilities are so broad, from funds that focus on social justice to bond funds that are geared towards community development. The main takeaway here is this: whatever your core value is, there is a very good chance a fund exists to help you support it.
Phew! We have covered a lot of ground, from broad index funds all the way to super specific thematic ones. So let's bring it all home and talk about your path forward from here.
Here are the 3 main things to remember. First, start with yourself. Figure out if you're an indexer, an activist, or a set-it-and-forget-it type. Second, know that no matter what your style is, high-quality options exist. And third, please remember, this is a starting point. Always do your own research on any fund before you invest your money.
We started this whole thing feeling a little overwhelmed, right? But hopefully you now have a map and a compass. By understanding your own investor profile, you can navigate this world with so much more confidence and purpose. So the only real question left is, where will you begin? So, you think you know sustainable investing, right? You pick a fund with green in the title, and you're good to go. Well, what if I told you that's just the tiniest tip of the iceberg? Behind every single ESG investment, there's this huge, mostly invisible ecosystem of players. Today, we're going to pull back the curtain and map it all out.
So who's really running the show here? I mean, who gets to decide what sustainable actually means? Who writes the rulebook, and who's the referee calling the plays? These are the big questions we're going to answer as we dive into this surprisingly powerful world.
You know, the best way to think about it is like a rainforest. You've got your towering trees, the complex root systems underground, the animals spreading seeds. Every single piece has a crucial role. Well, the ESG world, it's exactly the same. So let's meet the 4 key players that make this whole ecosystem work.
All right, first up, let's talk about the visionaries and advocates. These are the pioneers, the ones who first looked at the world of finance and asked, hey, what if investing could do more than just make money? They are the ones setting the North Star for this entire movement.
So what's their job? Well, they're basically the evangelists for responsible investing. They're non-governmental groups, so they're not out there making laws. Instead, they focus on the why. Their whole goal is to convince investors and companies that things like carbon emissions and how you treat your employees, well, that stuff isn't just nice to have, it's absolutely essential.
And believe me, we are not talking about some small, exclusive club. This is a massive, global movement. There are dozens of these organizations out there, from huge international bodies to tiny regional specialists, all working towards the exact same goal, making investing more sustainable.
And what's so cool here is just the sheer range. On one hand, you have absolute giants like the UNPRI, which influences trillions, with a T, trillions of dollars in assets. And then you have these specialized nonprofits like Sirius that really get into the weeds with companies on super specific issues like water risk. It's this perfect top-down, bottom-up approach working together.
Okay, so having a big vision is great, but without action, it's just talk. So how do you take these awesome ideas and turn them into actual, real-world policy? Well, that's where our second group comes in, the official rule makers.
This is really where the rubber meets the road. The rule makers are all about one thing: accountability. They create the systems that stop greenwashing in its tracks by making sure that when a company says it's sustainable, it's backing that claim up with real, hard, comparable data.
Now, these rule makers basically come in two flavors. First, you've got your government regulators like the SEC, who have the actual power to enforce laws. Then, you have the industry standard setters. They're kind of like translators, creating a common language so everyone is reporting ESG data in the exact same way. One is the law, and the other is the playbook.
Let me give you a real-world example. The Department of Labor can issue a rule that totally changes how your 401k plan is allowed to think about climate risk. At the same time, an organization like SASB is creating the specific standards that help a company, say Ford, disclose its progress on electric vehicles. One sets the rule, the other creates the report card.
Okay, so we've got the big ideas from the advocates, and we've got the rule book from the regulators. But in any game, you need a scoreboard, right? How do we know who's actually winning at this whole sustainability thing? Well, that's where our third group comes in, the scorekeepers.
Meet the data nerds of the ESG world. Seriously. The scorekeepers take all that complicated, standardized data and turn it into something an investor can actually use, like a simple letter grade, a score out of 100, or a stock market index. They're the ones who tell you if a company is an A-plus student or, if it's failing the class.
And hey, if you've ever seen a mutual fund with a sustainable label or a company with a high ESG rating, this is where that comes from. These scorekeepers are the engines running behind the scenes, crunching mountains of data to give you that one simple number or rating.
For example, a company like FTSE Russell creates entire stock market indexes based purely on ESG factors. You can think of it like an ESG version of the S&P 500. Then you have a service like ISS, which is more like a credit rating agency, but for ESG. They give individual companies a specific score, so one creates the league and the other ranks the players in it.
And that brings us to our final group in the ecosystem. If the others are the general practitioners, these folks are the neurosurgeons. They focus on one specific area with just incredible depth. Meet the focused specialists.
Look, these organizations don't try to boil the ocean. They pick one lane, either environmental, social, or governance, and they become the world's foremost authority in that space. But before we get to the examples, let's do a super quick refresher on what E, S, and G actually mean.
First up, E is for environmental. This is the one most people know. How does a company's operations impact the planet? We're talking carbon emissions, water use, pollution, basically its entire environmental footprint. Then we have S for social. This is all about people, inside and outside the company. How does it treat its employees? Are its products safe? What's its impact on the community? This is where the human side of business really comes into play. And finally, G is for governance. This is all about how the company is run. Is the board independent? Is executive pay out of control? Are they honest with shareholders? It's really asking, is there a responsible adult in the room?
And here you can see these specialists in action. An organization like Carbon Tracker does one thing, and they do it better than anyone: analyze the financial risk of climate change. Just Capital focuses entirely on social issues, literally asking the American public what they care about most. And the Council of Institutional Investors? They're a watchdog for shareholder rights. Each one is an absolute master of their specific craft.
Okay, visionaries, rule makers, scorekeepers, specialists. I know, it's a lot to take in. So let's bring this all back home. Why should you, as an investor, actually care about any of this? What is the bottom line for you?
It's like a chain reaction, really. It all builds on itself. The advocates create trust by setting a mission. The rule makers turn that trust into transparency through standards. The scorekeepers then turn all that transparency into useful, digestible data, and all of that comes together for the final, most important step. It puts the power right into your hands as an investor.
Here is the key takeaway from all of this. This entire ecosystem, this whole network working mostly behind the scenes, is what turns good intentions into a credible investment strategy. It is the engine that transforms your personal values into a real, tangible portfolio.
So, the next time you hear someone mention ESG, you'll know it is so much more than just a label on a fund. It's this entire world of advocates, regulators, and analysts, all working to make sure that label actually means something. So let me ask you, now that you know all the players, how does that change the way you see your own investments?
Okay, so let's talk about sustainable investing. It's everywhere, right? But with every fund out there calling itself green or ESG, you've got to wonder, how do you tell the real deal from just some really clever marketing? Well, that's exactly what we're going to tackle today. We're going to build you a toolkit to do just that.
This is the big question, isn't it? The one that probably keeps a lot of us up at night. You put your money into something hoping it'll do some good in the world, but then there's that nagging fear of greenwashing. Where it's all talk and absolutely no action. And you know what? That is a totally valid concern.
So right, this is the heart of the problem. How do you separate what's real from what's just a slick marketing campaign? It can feel, well, pretty impossible sometimes. But here's the good news. There is a way to cut through all that noise, and it really just boils down to one thing: knowing the right questions to ask.
The inspiration for this whole explainer actually comes from this amazing guide. I want you to think of it like an insider's playbook. It's basically a script of questions you can use to interview a fund manager, and it's designed to get you past all the fluff and uncover what's really going on with their strategy. This is how we get behind the glossy brochure.
So what we're going to do is take the best ideas from that guide and turn them into a super practical toolkit just for you. Seriously, by the time we're done here, you're going to have a straightforward framework you can use to look at any sustainable fund and really understand what you're getting into.
All right, let's get into it. Here's what's in our toolkit. We've got 4 main checkpoints. First, we'll assess the ESG quality. Then, we'll try to understand the ESG tilt. After that, it's all about evaluating active engagement. And finally, we'll gauge their true commitment. Then, we'll wrap it all up. Ready? Let's go!
Okay, checkpoint number 1, assessing ESG quality. And I love the question on the slide here, are the ingredients any good? Because it's just like cooking, right? You can't make a great meal with bad ingredients. And in the world of investing, those ingredients are the data and the research that the fund manager is using.
So, the first thing you've got to ask is, where are they getting their information? Are they just grabbing the same off-the-shelf ratings from the usual big research firms that everyone else uses? Or are they digging deeper, looking at a much wider range of sources? This one question tells you a ton about how deep their work really goes.
And this next one, this is a huge one. Simple question. Do you do your own homework? See, if a fund is actually doing its own proprietary research, that's a massive signal. It means they have a way deeper level of expertise. It shows they're not just looking at the same stuff as everybody else on the street.
Okay, and this question is absolutely critical. It's the ultimate test of whether they're actually looking ahead. Are they just looking at a company's carbon footprint right now? Or, and this is the key part, are they thinking about the future risks? Like what happens with new regulations, new technologies? What about the physical impacts of a changing climate? This is what separates the really sophisticated players from the rest.
All right, so we've checked the ingredients. Now for checkpoint 2, we need to understand the ESG tilt. Basically, how are those ingredients actually used in the recipe? Is sustainability just, a little sprinkle of parsley on top for decoration, or is it a core essential part of the whole dish? And this is so important to understand. Not all ESG investing is the same. There are really 3 different levels. At the bottom, you have consideration. This is kind of like a last-minute check. Then you have integration, where ESG stuff is looked at right alongside the financials. That's better. But the top tier is ESG focused. This is where sustainability criteria are the main driver for why an investment is chosen in the first place. And your goal is to figure out where on this ladder a fund really stands.
So you ask them this: what are your most important ESG themes? And what this does is it forces them to be specific. A wishy-washy answer is a red flag. You want to hear things like, we focus on clean energy, or water scarcity, or supply chain labor rights. A sharp, confident answer tells you they have an actual strategy, not just a marketing label.
And here's your accountability question. It's simple. Do you publish reports on your ESG impact? I mean, any fund that's actually serious about this stuff should be totally open about their results, right? It's like in school. You got to show your work. This is how they prove they're making a difference. Okay, so reporting is one thing, but actually creating that impact, that's a whole other level. And that brings us to checkpoint number 3, active engagement. See, it's not enough to just own shares in a good company. The real question is, does the fund manager use their power as a shareholder to push for positive change? Are they just sitting on the sidelines, or are they actively trying to make things better? And they've got a whole toolbox for this. It can be something as simple as using their votes at shareholder meetings, that's proxy voting, or it could be having direct conversations with the company's leadership. Then you get to the more heavy-duty stuff, like filing shareholder resolutions or even teaming up with other big investors to really turn up the heat. The bottom line is, the more these tools are using, the more serious they probably are about this whole active owner thing.
This one really gets to the heart of their strategy. You ask them, so how do you decide what issues to focus on? What you're looking for is a clear process. It reveals what their real priorities are. Is their engagement strategic and focused, or is it just kind of random and all over the place? Big difference.
Okay, but pushing other companies to be better doesn't mean much if the investment firm itself isn't walking the talk. And that's our final checkpoint, gauging true commitment. This is where we zoom out from looking at just one fund and we start investigating the entire firm behind it. Is sustainability just another product on their shelf, or is it baked into their corporate DNA?
This question really pulls back the curtain. You're asking, what are you doing internally? Do they have their own carbon reduction goals? What do their diversity and inclusion numbers look like? A firm that practices what it preaches? Well, that sends a really powerful message about how authentic they are.
And this last one is a big picture question. It asks if they're just trying to sell you a trendy product, or if they're actually trying to lift up the entire industry. Are they helping to make all of finance more sustainable? This really tests whether they're committed to the movement or just to their own profits.
And there you have it. That's your 4-point investor toolkit. By checking on ESG quality, the ESG tilt, active engagement, and their true commitment, you now have this really powerful way to analyze any fund and see what's really going on under the hood.
You know, at the end of the day, this toolkit isn't really about finding some mythical, perfect fund. It's about empowering you. It's about giving you the confidence to ask smarter, tougher questions so you can see right past the slick marketing and get to the real substance of what a fund is all about.
So just think about this for a second. What if every single investor started asking these kinds of questions? Imagine the pressure that would create. The industry would have to become more transparent, more committed. When you ask better questions, you're not just doing something good for your own portfolio. You're actually helping to build a better, more accountable financial system for all of us. Thanks so much for joining me.